Okay, welcome everybody. These are the notes for Thursday, September 7th. Will be in New York City, so of course I'm not there physically, but these are your notes for mostly Chapter 2, but I decided to go back and cover what we didn't cover of the Chapter 1 slides as well, because I think we'll have time for that to work. You can see the first exercise here we're going to look at is preparing a balance sheet from a list of accounts. So you're given the accounts in alphabetical order, and then you are asked to put them into a balance sheet format. And what that requires you to do in terms of the learning that it's testing or helping you to demonstrate is whether you can classify each of these accounts correctly. And now the good news is they've only given you balance sheet accounts to work with, so at least you're not going to mix up the revenue and the expenses that go on the income statement with these accounts that go on a balance sheet. But my recommendation is the first step you would take would be to just go through the list of accounts and label each one of them according to whether they are assets or liabilities or stockholders' equity accounts, or whether they're totals or subtotals. First of all, accounts payable is going to be a liability, so when you make your balance sheet, that will go in the liability section. Accounts receivable is an asset. Now let's talk about the difference between those two, because a lot of times when students are first starting accounting, they get the two of those mixed up. Accounts payable are amounts that the company owes to its suppliers because they've bought things on credit. So they've usually bought inventory without having to pay for it immediately, and so they still owe the suppliers for that inventory. And it's payable because the company is going to be paying it once that time passes and the bill is due. Accounts receivable are the same type of transaction, but it's viewed from the company that is the seller rather than the company that is the buyer. So when the company is the buyer, then they have accounts payable. When the company is the seller and they sell that stuff on credit, then they have accounts receivable. They have the right to receive that money from the customer. So when it's a payable, it's a liability. When it's a receivable, it's an asset. Cash, of course, is an asset. Common stock is stockholders' equity that represents the amounts contributed to the company by its stockholders. Equipment is an asset. Inventory is an asset. Equipment and inventory and cash are all things that the company owns, resources the company has that will benefit them in the future. Accounts receivable fits into the asset category because it is a right to receive something that's going to benefit them in the future. Notes payable is a liability. Again, that word payable is a pretty big clue that it's something the company owes. It's something they have to pay later, and therefore it is debt or a liability. Retained earnings is a stockholders' equity account that represents the amounts that the company has earned over time rather than being contributed. So we have a contributed capital that's common stock, and we have the earned capital that is retained earnings. And then, of course, we've got a couple totals, the asset total and then the liability and stockholders' equity total. And, of course, those two totals should equal each other. But let's make sure that once we get everything into the proper place on the balance sheet that actually works. First of all, our asset section of the balance sheet, we're going to take the cash and the accounts receivable and the inventory and the equipment and then total them together. And as the total was actually was it given to us? Yes. As that total was actually given to us, we didn't even have to add it up, but it's a good idea to add them up and make sure that that really is what they totaled to. We then move on to the liabilities and equity section of our balance sheet. And so we'll start with the liabilities and put those on there. The accounts payable and the notes payable, and we'd add those together to get total liabilities. That part you could have left out because it didn't tell us we had that line item. And then stockholders' equity would consist of the common stock and the retained earnings, and we could total that one separately as well. Again, you didn't have to put those separate subtotals in there since it didn't list those. But then we definitely need that final total for the total liabilities and stockholders' equity. And once we add together the total liabilities and the total stockholders' equity, they do indeed sum to the $1,262,100. Notice the double underlines under total assets and under total liabilities and stockholders' equity, that indicates that our balance sheet does balance, that those two amounts that are supposed to be equal are in fact equal. And that's all there is to preparing a balance sheet. Of course, they get bigger than this. This is a very small one. But the key is just to be able to classify the accounts into the proper categories. The second question asked what portion of the financing came from stockholders versus the financing that came from creditors. And as you can see from this balance sheet, the stockholders have financed the $858,600, whereas the creditors have only financed $403,500. The amount that the creditors have financed basically is the total liabilities, and the amount that the owners have financed is the total stockholders' equity. Okay, the next example was to prepare an income statement and also to infer some missing values. So that means you'll fill in what you know and then use that to determine what you don't know. Now here again, they've given us some various accounts and we just need to put them into the proper format for an income statement. And again, they were kind to us and only gave us income statement accounts. When you get a little bit further on, and maybe in the next chapter or so, they'll mix them together. So you'll see asset, liability, owner's equity, revenue, and expense accounts all mixed up together. And then you have to know which one goes on which statement, not only where do they go on that statement. And so in this case, we're simply going to start with the revenues, and we'll list our revenues, and then we'll list our expenses. You'll total the revenues, you'll total the expenses, and that's one of the question marks, and then you'll subtract the total expenses from the total revenues to get the net income. And so to fill in that first question mark, total expenses would add up to that, and the net income would then be $80,700. We can see that the main source of revenue that the Cinemark Holdings has is the admissions revenue. And the biggest expenses are the office expenses and the film rental expenses. Okay, now we're going to do a problem where we're inferring values using both statements. And so they give us some columns here. They give us revenues, total revenues, which would be on the income statement. They give us total expenses that would also be on the income statement. And they subtract the two to get the net income or net loss. If it's a negative number, it would be considered a loss. And they also give us the assets, the liabilities, and the equity from the balance sheet. And then we're supposed to use the relationships that we understand among these items to try to fill in the missing values. Well, for independent case A, independent means that A's numbers have nothing to do with B's numbers, have nothing to do with C's numbers, and so on. Each case is independent of the other. So for the first case, A, we're going to first take the total revenues and subtract the total expenses, and that will give us the net income number. Guess I got a step ahead of myself there. Let me back up. We're going to start by doing both parts of A. To do the net income, we would take the revenues minus the expenses, and to get the stockholders' equity, we would use that equation of assets equals liabilities plus stockholders' equity, and so we would take the assets minus the liabilities to get the difference that is the stockholders' equity of $80,000. For case B, we're going to still use those same two equations. We're going to use the revenues minus expenses equals net income, and so we're going to take basically R minus 80,000 and set it equal to 12,000 and figure what R must be in order for that to happen. And then on the balance sheet side, we're going to take the assets of 112,000 and set that equal to L plus stockholders' equity, and we're going to see what L must be in order to make that work. And so if we use the algebra to do those two equations, we're going to see that the revenues would have had to be 92,000 for that equation to work. And on the other side, the liabilities would have needed to be 42,000 for that equation to work. We do the same thing with letter C. If revenues are 80,000 and expenses are 86,000, that means we're going to have a loss of 6,000. And if our assets are 104,000 and the liabilities are 26,000, that means that the equity must have been 78,000. Letter D, we work the same way. If revenues are 50,000 and income is 20,000, that means that the expenses had to have been 30,000 for that equation to work. And if our assets are what we're trying to calculate, and we know that they are equal to the total of the liabilities and stockholders' equity, we'll simply add together the 22,000 and the 77,000, and that will give us our total assets as 99,000. And then for letter E, if revenues are what we're looking for, we would know that if we subtracted from that unknown value 81,000, we get to a net loss of 6,000. That means that our revenues must have been 6,000 less than our expenses, and so that's going to be 75,000. And then again on the other side, we simply add the liabilities and the stockholders' equity to get the asset value as 101,000. So hopefully that helps you to better see the equations that are underneath those financial statements and get familiar with the relationships there. Okay, now we'll start Chapter 2. So Chapter 2, we're going to look at the mechanics for how we get information from the transaction stage onto our financial statements. And the first thing we need to do in order to understand those mechanics is we need to talk about debits and credits. Now, I think I mentioned in class on Tuesday that you can think of that accounting equation as kind of like a balance scale. You see here that you have this scale with these trays on both sides, and as long as whatever's on the trays on both sides are equal, they're going to hang evenly. If we put something heavier on one side than is on the other, then one side's going to tip and it's going to be weighted down. The balance sheet always needs to be in balance, so those trays need to be equal. So anytime we put something on the asset side, we also have to put something on the liabilities and equity side, or we can take something else back off the asset side of an equal value to what we added. And so every transaction that we enter has to make that scale stay in balance accordingly. Now, what do assets and liabilities and equity accounts have to do with debits and credits? Well, the term debit simply means left side, and the term credit simply means right side. And so because the assets are on the left side of the accounting equation, they are debit balance accounts. The balance of an asset account, if it's a normal asset, is simply going to be a debit balance. Again, because assets are on the left side of the equation and the word debit means left side, the asset accounts are going to have debit balances. That means that transactions that increase assets are going to debit the asset accounts. The entries to that will be added on the left side of that account, and decreases in asset accounts will be entered on the right side. And so if you were going to calculate the balance of the asset accounts, you would add together everything on the debit side, you would add together everything on the credit side, and then you would subtract the credit side from the debit side, and the balance would be on that debit side. Now, every once in a while, you'll have an asset whose balance goes negative, and then that means the credits are bigger than the debits, and so it ends up being a credit balance when it really should be a debit balance. You'll notice that the liabilities and equity are on the opposite side of that balance scale there, and therefore they behave the opposite way. And so liabilities, because they are on the right side of the accounting equation, they're going to have right side balances, which are credit balances. So the credit balance is the normal balance for liability, whereas a credit balance would be very unusual for an asset account. It's the normal type of balance for a liability. If you ever saw a liability with a debit balance, you would know something had gone terribly wrong, because liabilities should have credit balances or right side balances. That means transactions that increase liabilities would be entered with credit entries, right side entries, and transactions that decrease liabilities would be entered with debit entries. And then same thing with stockholders' equity. They will have a credit balance as their normal balance. Their values will increase with credit entries and will decrease with debit entries. So 3 important rules. Accounts increase on the same side as they appear in the accounting equation. So assets are on the left side of that equation, and therefore they increase with left side entries. Liabilities in stockholders' equity accounts are on the right side of that equation, and therefore they increase on the right side, the credit side. Left is debit, right is credit, and the normal balance is the side on which the account increases. Now, how do we get those transactions recorded into those accounts? The first step is we record journal entries. And a journal is actually in chronological order. And so we'll look at the transaction and we'll say, okay, what happened here? For example, you'll see the first entry there on August 1st is a debit to cash and a credit to common stock. And then in parentheses, we see that it's for financing from stockholders. In other words, the stockholders gave the company cash, and the company in exchange gave the stockholders ownership or partial ownership of the company. The cash account is an asset account, and since the cash increased to the company, we're always looking at it from the company's perspective. The company received cash, and therefore its cash increased. And because asset accounts are on the left side of the accounting equation, they increase with left side entries, and therefore we're going to debit the cash account for $10,000. Common stock is a stockholders' equity account, which increases with right side entries. Its normal balance is a credit balance, and so to record the increase in the common stock, we credit the common stock account. So notice that both accounts that were involved in this entry increased, but because one of them was a left side account, cash, and the other was a right side account, common stock, the debits and the credits are equal and our accounting equation stays in balance. The second transaction you see there in the journal is a debit to logo and trademarks. Logo and trademarks is an intangible asset that represents those resources that the company has. You're probably all familiar with the fact that most companies have a logo that distinguishes them at a glance, and many of them also have trademarks. And those logos and trademarks have value to the company. And in this case, they bought their logo and they used cash to do it. So the logo and trademark is an asset account that increased in this example, and the cash is an asset account that decreased in this example. And so the journal entry that you see here debits the logo and trademarks account, increasing that asset, and the second part of the entry credits the cash account, thereby decreasing the cash account or representing the fact that the cash decreased. Again, the left side, the asset side, it increased and therefore it got heavier with the first part of that entry, but then we took another asset of the same amount back off, and so the scale evened back out again. And the third entry you see there is a purchase of an application meaning a software app, using cash and credit. So we can see that their software asset increased, that asset they purchased, and so we debit it. And in exchange for the software, they gave up cash and they agreed to pay some more later. And so the price of the software was $9,000. On the day that they purchased it, August 29th, they didn't actually pay all of it in cash. They paid $4,000 in cash, and so you see the credit to the cash to show that decrease. And they still owe another $5,000 to whoever they bought that software from. And so now they have a liability that has increased by $5,000. So the assets increased by $9,000. a different asset decreased by $4,000 and a liability increased by $5,000. And if you net those effects together, you'll see that even though it's not a two-part entry, it's instead a three-part entry, we still kept that balance sheet scale in balance. And every journal entry that you'll make in this class will have to accomplish that. You'll always have to have debits that their total equals the total of the credits in that entry. Not all entries will just have two parts like those first two did. Some will have three parts like that third one. Some will even have more than three accounts that are affected. It's fine to combine as many as you need as long as the total of the debits equals the totals of the credits. I want to also point out the format of these journal entries in terms of the debit part of the entry is typically entered first, and the account names that are being debited are entered at the leftmost portion of that account titles and explanation column. You'll notice then that the credit accounts, the accounts that are being credited, are indented a little bit, and that's just convention. It's just how accountants have been entering these things for years, and so you want to stay consistent with that. What's even more important is to make sure that you enter it in the correct column. So the cash entry is being debited, so that $10,000 had to go in the debit column. If you had accidentally put that in the credit column, that would be a big problem. So make sure that you get the amounts in the proper column. And if possible, also try to write the account names using that convention of whichever accounts are being debited, put them flush left, and whatever accounts are being credited, indent them a little bit. Okay, so this is just showing us a little bit more about that software entry where we increased the software asset, decreased the cash asset. Notice the opposite debit and credit effects there, and then the increase of the accounts payable that credited the accounts payable. Okay, what happens once those entries are all entered in the journal is we then post them into the accounts. The journal is important for capturing the transactions in chronological order and making sure that we're recording everything that happens. But once it's in that format, it's difficult to use. If you had a 50-page general journal and somebody asked you to say, okay, so those are all your accounting transactions that happened, what is our balance in cash? That's going to be difficult to explain using the journal. You could do it. You could go through and find every entry that affected cash and net them together, adding the ones that increased cash and subtracting the ones that decreased cash. But it would take a long time if you had to do that every time you wanted to know the cash balance. And so instead, what we do is once we finish making the general journal for whatever time period, a day or a week or however often we're going to update things, we then post those entries to the general ledger. The general ledger is not a chronological record of what happened, but rather it's in account order. And so we have what's called a chart of accounts in companies, and we will put the general ledger, each account that's on the chart of accounts will go on the company's general ledger, where we'll keep track of the increases and decreases in that account. And so you'll notice here that in the general ledger we have three different accounts. One is account number 186, which is the software account. One is account number 100, and that's the cash account. And the other is the account number 200, which is the accounts payable account. The process of posting is quite simple. All we do is we say, okay, the journal entry shows that we need to debit software for $9,000. So let's go to the software account in the general ledger and let's put in today's date, reference the general journal page 1 for that entry, write in the debit to software, and calculate the balance. In this case, the software did not have a balance coming into this transaction, and therefore its balance is simply the total of the new transaction that we posted. If it had already had a balance in it, then we would add the amount that we debited to the previous balance. And you'll be able to see that more clearly by looking at this cash entry. So the entries that were made August 1st, 2nd, and 3rd have already been posted into the cash account, and now we are entering the entry from August 29th. The entry from August 29th in the general journal showed that we need to credit that cash account, which is number 100, for $4,000. And so we go to the general ledger and we find the cash account, which is account number 100, and we write in August 29th for today's date, and we write in a credit entry of $4,000, and then we recalculate the balance, seeing that the balance now has gone down by that $4,000 amount. And then we take the third part of the entry, the accounts payable credit, and we do the same thing. We find the accounts payable account on the general ledger, and we add a credit entry to that account and recalculate the balance. So that's how we summarize that chronological information into information that will be useful when we need to know what the balance of a specific account is. Okay, now in this slide, the pictures that you see of the general journal and the general ledger are the formal notations. They're what they used to look like on ledger paper when everything was done manually. And they're similar to what you'll often see on screenshots of general ledger accounting software packages. And so it's fine to see them in that format. When we're doing homework problems, though, we often don't have blank journal paper and blank ledger paper to work with. And so we use some shortcut notation that you're going to see here. So for a journal entry, instead of showing the columns and the rows in that journal paper format, we simply will write out the account names. Again, notice that the accounts that we're debiting are going to be listed flush left in the entry, and then the accounts that we're crediting are going to be indented slightly. So you see that the cash there is indented because it's being credited, and the accounts payable is indented because it's being credited. Notice it doesn't have to do with whether it's being increased or decreased, because cash is decreasing with that credit entry, but accounts payable is increasing with that credit entry, and that has to do with the nature of the accounts. And then to show the journal entry being posted into the general ledger, notice that our ledger accounts there, again, aren't on official ledger paper. Instead, they're in what we call T-account format. And with T-account format for our general ledger accounts, we simply put in a structure that looks like a T. See, the bolded lines within each of those accounts is shaped like a T. And then we start with the beginning balance on whatever the normal balance side is for that equation. In this case, all of the beginning balances were 0 because it was a new company. And then you'll notice that when we post each transaction, we're going to label it with a letter. And so we aren't posting letters A, B, C, D, E, and F in this example, but we can see that somebody else already has posted those. And whatever transaction F was, it didn't affect the cash account or the software account or the accounts payable account. But transaction G does. Transaction G is going to be debited to the software, so we enter it on the left side of the T and recalculate the balance for that account. And then we go to the cash account, and our entry is crediting cash. So in the cash account, we're going to add a credit entry of $4,000. And then if it was time to calculate the ending balance of the account, we would factor in what was already there, plus whatever debit entries were made, and then minus the various credit entries were made. And that ending balance is a positive balance, therefore it goes on the normal side, which for an asset is the left side. And then our accounts payable, we take that credit of $5,000 and we add it on the credit side or the right side of the accounts payable account. and we net those values that are there together. So we started with 0, then we added 9,600 and subtracted 5,000, and then added back another 5,000. So we ended up with 9,600. Once we've entered journal entries for a prescribed period of time, and it's time to, we want to check and make sure that we don't have any egregious errors. We're going to check the accounting records to make sure they're in balance by making what we call a trial balance. For a trial balance, we simply take the general ledger account, which has had all these different journal entries posted into it, and we list all the balances. And those accounts that have debit balances, we write their value in the debit column of our trial balance. And those accounts that have credit balances, we list them in the credit column of our trial balance, and then we simply add up the two columns to make sure that they balance. Now you might be wondering about the order in which the accounts are listed on the trial balance. They're simply listed in chart of accounts order. And chart of accounts order starts with the asset accounts, and the asset accounts are typically listed in the most liquid order. In other words, how soon will they be turned into cash? That if they're going to be turned into cash pretty soon, they're considered liquid, and they're going to be listed earlier than if it's going to be a long time before they're converted into cash or used up. In this case, cash is already cash, so that's really fast. Supplies are not going to be turned into cash, but they're going to be used up fairly quickly, and so we see they're listed next. Equipment is going to be used over a much longer period of time, as is software and the logos and trademarks, and so those are listed next. Within the sort of liquidity categories, it doesn't matter what order things are in there. So we could have put software first and then equipment if we wanted to. In this case, I think they just chose the dollar values and listed them in descending order, but I'm not going to get picky about that order. And then on the liability side, we see the accounts payable and the notes payable. Those again are typically listed in order of how fast they have to be paid back. Usually accounts payable are due within about 30 days. Notes payable oftentimes are longer term, and sometimes they're longer than a year, so sometimes they're very long term. And then common stock, of course, is an equity account, and so we see that next. In this case, our total debits equaled our total credits, and our trial balance was therefore in balance. Now, balance sheets often are what we call classified. And so instead of just thinking about liquidity overall, we're going to think about short-term and long-term assets and liabilities. The short-term assets, those assets that are going to be converted into cash or used up within a 1-year time frame, are considered current assets. Short-term assets, current assets means the same thing. Those assets that are going to last longer than a year are considered long-term assets. And so you'll see in this classified balance sheet that's showing here, the cash and supplies are listed under a current asset subheading, and then the other assets are listed separately, so equipment and software and logo and trademarks. And then we add the total current assets to those other three asset values and come up with the 40,200. We also classify the liabilities as current and non-current, or short-term and long-term. And so in this case, the accounts payable is a current liability because, as with the accounts receivable, they typically, the bill is going to be due in less than 30 days. The notes payable in this case was a long-term liability. They didn't give us the information to calculate that or to figure that out, so just we have to take their word for it that they intended that to be a long-term note payable, because notes payable can be short-term as well. You can have 90-day notes or 180-day notes and things like that. And so you can see that to prepare a classified balance sheet, you use the same basic format as a regular balance sheet, but you just add the current asset subheading and the total current asset subtotal, and you add the current liabilities heading and the total current liabilities subtotal But other than that, it's pretty much prepared the same way as a regular balance sheet. Now, one of the reasons why it's useful to separate the assets and the liabilities into current and non-current categories is in order for us to determine how likely it is that the company is going to have the money it needs to pay its bills as they come due. That's what we call liquidity. And so we put the accounts in liquidity order so that then it's easy to assess liquidity by looking at certain things. We have a measurement that we call the current ratio, where we take the current assets, in other words, those assets that are likely to be turned into cash or used up within a 1-year time frame, and we divide those by the amounts, the current liabilities that have to be paid within the next year. If this ratio turns out to be greater than 1, then we know we have more current assets than we do have current liabilities, and we're likely to be able to pay off those current liabilities as they come due. The higher the current ratio, the more liquid the company is, and you would think then we just want as big a current ratio as we can get. But there is a little bit of a caveat there that we don't want to just hoard current assets. We don't want that ratio to get too big. And we like it to really be somewhere around 2, or between 1 and 2 for some industries is fine. We're probably not going to get panicked if it goes as high as 3 or 4, but if we're seeing current ratios that get up in the 6 and above range, then we're probably maybe having too much. In this case, our current ratio is 21,300 divided by 10,200, which comes out to 2.09, and that's a very comfortable current ratio. We would be pretty happy with that. Okay, so let's think about the balance sheet for a minute. You see the kinds of things that are on a balance sheet, but what kinds of things are we not recording that seem like they should fit? For example, if we think about human capital, our people can be the greatest assets that a company has, but we can't own our people, and therefore we can't put those things on there. So things like the people's creativity and vision and things like that, they just don't show up on that balance sheet. Another thing that's important to think about is the cost value. We talked a little bit about this on last Tuesday, or last Thursday. I guess that was last Thursday. And we said that the assets have to be recorded at their cost value. And even if the value of that asset goes up, we're not going to be allowed to put that increased value on our balance sheet. So if we bought a piece of land, it was the example I think we used for $100,000, and it increased in value to $1 million, we can't increase that value on our balance sheet because it's too expensive to get appraisals done all the time whenever we're making financial statements, and there's not a ready market value for a lot of those things, and so it would be there's not like we could look it up. Now, if we know that the asset has decreased in value, if we had some kind of an assessment or something that showed that we had lost value on that land, maybe it developed a sinkhole or something, and we know for sure it's not worth as much as we paid for it, we do have to find a reasonable estimate and decrease that asset value on our balance sheet, because we have this principle called conservatism that says that we want to avoid getting anybody's expectations inflated. So we're going to make our assets, we're going to err on the side of caution and lower values for our assets, and the same thing for our revenues. We would rather understate our revenues than to overstate them, because otherwise we'll get people's hopes up in error. Okay, so those are the basic concepts of the chapter. Now let's look at a few examples. So here we have an example of a company that was incorporated on July 1st, and we're preparing the journal entries for the first month that this company was in business. And one of the things we'll need to do for each of these is determine whether it even is an accounting transaction or not. Because it's only an accounting transaction if it has an effect on an asset, a liability, and or an owner's equity account. So let's take a look. The first letter A says received $70,000 cash invested by owners and issued stock. So we're basically trading ownership in the business for cash that the stockholders are giving to us. That is an accounting transaction because it affects cash, which is an asset, by increasing it, and it also affects common stock, which is an equity account, and it's increasing it. Notice that I debited cash because it's an asset that's increasing, and assets are left side accounts, and therefore they increase with left side entries. Common stock is a right side account, and therefore it increases with a credit entry. The second one says we bought an unused field from a local farmer by paying $60,000 cash. Those are both assets, and so we know it is an accounting transaction. And it says as a construction site for smaller projects, it's estimated to be worth $65,000 to JK Builders. Doesn't matter what it's worth to them, it matters what they paid for it. And since they paid $60,000 cash for it, that's what we're going to use as its value. So we would debit the land because land is an asset. That makes it a left side account, and so we give it a left side entry. And we gave up cash. Cash is also an asset, but now we're decreasing it, and so we're going to credit the cash for the $60,000. We just ignore the $65,000 worth because that's not what we paid for it. And then letter C, the lumber supplier delivered lumber supplies to JK Builders for future use. The supplies would normally have sold for $10,000, but the supplier gave them a 10% discount. They have not yet received the $9,000 bill from the supplier. Again, we're going to record this for the amount that they are going to pay for it. So we're going to use the $9,000 amount here. And what we have here is the lumber supplies are an asset, and it's an asset that's increasing. So we're going to debit the supplies for $9,000. And then because we haven't yet received the bill and we haven't paid for these yet, we're going to credit accounts payable, which is a liability, and that liability is increasing, and therefore we see that credit entry. Letter D says we borrowed $25,000 from the bank with a plan to use the funds to build a small workshop. We must repay the loan in 2 years. And then we've got another transaction where one of the owners sold $10,000 of his stock to a different shareholder for $11,000. So we'll look at the two of those. The first one, if we borrowed from the bank, that means we received the cash. Cash is an asset. Assets are left side accounts, so we need a left side entry to increase that asset called cash. And we need a right side to balance out that transaction to represent the rest of it. And in this case, we need to record a notes payable. In this case, it is a long-term notes payable. And because liabilities are right side accounts, we have a right side entry to increase that liability. Now, letter E is a little bit tricky because that's actually not a transaction for the company. Instead, that would be a transaction that's purely between the independent individuals. And so there's no asset, liability, or equity account affected on behalf of the company. It's just between the two people. Okay, here's another one. Joel Henry founded bookmark.com at the beginning of August. The journal entries were again looking at these transactions or these activities and determining whether they are accounting transactions. And if they are, we make the journal entry. And if they're not, we write no transaction. The first one says the company purchased equipment for $4,000 cash. They expect to use that equipment for 10 or more years. That means they're trading the asset called cash for an asset called equipment. So they have one asset that's increasing and one asset that's decreasing. The asset that is increasing would be increased with a debit entry because assets are left side accounts, and so they increase with left side entries. So we're going to debit that equipment for $4,000, and then the cash is decreasing, and to decrease a left side account we need a right side entry, and so we're going to credit cash for $4,000. Letter B then says that we bought $7,000 worth of books from a publisher and we'll pay for those within 45 to 60 days. So basically we're buying something on account. And so we're going to first debit the inventory, and we know it's inventory because it's a bookstore, right? If it hadn't been a bookstore, if they'd been something else, we would have had to say, okay, are those supplies? What are those books to this company? But in this case, we know that it is inventory. Inventory are the products that we intend to sell in our company as part of our normal business operations. So we're going to increase that inventory asset by $7,000, and because we haven't paid yet, we can't credit cash. Instead, we're going to credit this accounts payable account that indicates that we still owe the publisher this money. The third transaction, a friend of Joel lent $4,000 to the business, and they actually issued a note promising that they would repay that in $4,000. And they're not paying any interest, so we'll avoid that complication for right now. Later in the semester, we will deal with some interest-bearing notes as well. So in this case, the company is getting cash, and they're incurring a liability or an obligation to pay later. So to record the cash we received, we debit cash, and to record the fact that we now owe some money, we credit the note payable. And in this case, this is a short-term note payable because it's payable within 4 months, which is less than a year. And then we paid $1,500 cash for books purchased on account earlier in the month. So earlier we made that entry purchasing some books on account, and now the company is paying cash for some of those books. We're not going to re-record the books. We're not going to record, that would make it look like we bought more inventory, so we can't do that, right? Instead, we're simply going to debit the accounts payable because now we don't owe that anymore, and credit the cash for the amount that we paid. And then letter E is similar. We're repaying the $4,000 loan that you see up there in entry C. And again, we didn't get more cash in this case. Instead, we're paying cash out. And so we're going to credit cash to decrease the cash. And then on the notes payable side, we're going to debit the notes payable to indicate that now that we paid it, we don't owe it anymore. So that liability decreased as well as our cash decreasing. Okay, here's another one, Sweet Shop Inc. It's got some transactions or activities there that we need to determine if they are transactions, and if so, what would they make for their journal entries. The first example, they ordered and received $12,000 worth of cotton candy machines, so that's equipment, and they're going to pay for it within 45 days. So it's a short-term obligation. It doesn't say anything about signing a note, and it looks like that's part of their normal business operations, and so we're going to assume that's accounts payable when we're buying on credit like that. And so in this case, we're going to debit the equipment for the $12,000, and we're going to credit accounts payable for $12,000. Transaction B, we sent a check for $6,000 to candy makers for partial payment of the cotton candy machine from letter A. And so now we're going to take part of that accounts payable, not the whole $12,000, but the part that we did pay. We're going to decrease the accounts payable account by debiting it, and we're going to decrease the cash account by crediting cash. And then letter C, we received $400 from customers who bought candy on account in previous months. And so we hadn't recorded those entries in this example, but somebody already would have recorded the sales that they made to those customers and the increase in accounts receivable that they would have recorded at the time. So now we're simply receiving the cash, so we're going to increase cash, and we're going to decrease the accounts receivable. That's what would have been increased in prior months. We're not going to record the revenue because it said they bought them in previous months. We don't want to mix up what happened in a different time period with this time period. And we assume that when they made the entries to record the sales in those previous months, they would have already recorded the account receivable. And so now we decrease that receivable. Letter D, we're helping raise funds for store upgrades estimated to cost $20,000, and they decide to do that by issuing common shares for $15 each to existing stockholders. And so they didn't raise the entire $20,000, but they raised $15,000 by selling shares of stock. And so we ignore the $20,000. That hasn't happened yet. Maybe eventually we'll get up to the $20,000, but right now we can only record what we actually have accomplished. And that is we received $15,000 in cash, so we're going to have a debit to cash for $15,000, and we're going to credit common stock because those were amounts that were contributed to the company by the existing stockholders. And then letter E, we bought ice cream trucks for $60,000 total, paying $10,000 in cash and signing a long-term note for $50,000. That means we owe that $50,000 still. And so we're going to look at the ice cream trucks and realize those are an asset. We'll call them equipment, and we'll increase those for the $60,000 total by debiting the equipment for $60,000. Then our cash has gone down by $10,000, so we're going to record the credit to cash to record the decrease, and that showed up on the wrong side for some reason there, so I apologize for that. Just move that $10,000 over to the credit column. It's shown correctly as a minus A, but it should be indented a little bit and moved that $10,000 over into that second column. And then the notes payable increased, and that's a liability account, and so we credit the liability for $50,000. Okay, here's another problem, and this one says that we're managing an arcade that provides entertainment for parties and special events, and so we're still doing transaction analysis and making journal entries. In letter A, they received $50 cash on account for a birthday party held 2 months ago. Here again, they would have recorded the revenue 2 months ago when the birthday party happened. And so at that point, they would have set up an accounts receivable, given that the customer hadn't paid yet. Now, when they're receiving the cash for that, they're not re-recording revenue, but instead, they're increasing cash and decreasing accounts receivable. Letter B, agreeing to hire a new employee at a monthly salary of $3,000, and the employee will start work next month. Even though they've made a commitment at this point to the employee, there's no asset account or liability account or equity account that has been affected, and so B would result in no transaction. Once the employee actually starts working, then we will have transactions to record. And then C, paying $2,000 for a tabletop hockey game purchased last month on account. Well, we would have recorded the asset of the hockey game last month when we got it. And so now all we're doing is making a payment on account. So when we bought the game last month, we would have increased the asset by debiting it and increased a payable by crediting it. Now we're going to decrease that payable by debiting it, and we're going to decrease our cash because, of course, we're paying cash out. Then we repaid a $5,000 bank loan that had been outstanding for 6 months, and we're ignoring interest still at this point. And so we would simply show the decrease in the loan by debiting the loan account, and we would show the decrease in the cash by crediting the cash. Now we purchase a new air hockey table for $2,200, paying $1,000 in cash and signing a short-term note for $1,200. That means we borrowed the other $1,200 basically. And so we're going to increase the asset account for the equipment for the table itself by $2,200, and we're going to credit cash for the $1,000 because we're decreased our cash, and we're going to credit the notes payable, which increases that liability by the $1,200. Okay, now we're going to look at a little bit differently. So we're going to see these transactions that have occurred, and we're going to indicate the effect on the accounting equation. And so you can see first, for that first transaction of receiving cash from the owners and issuing stock to them, rather than looking at it in a journal entry format, we're looking at it in an accounting equation format. And so under letter A at the bottom there, you see that we increased our cash by the $10,000. That was under the asset side, and we increased our stockholders' equity through common stock of $10,000. The second entry then, we borrowed $7,000 cash from a bank and signed a note due later this year, and so we debited cash, which increased our assets, and we would have credited notes payable, which increased our liabilities. Letter C, we bought and received $800 of equipment on account, and so under the asset side we show that increase in the equipment, and under the liabilities side we show the increase in accounts payable. Letter D, we purchased land for $12,000, paid $1,000 in cash, and signed a long-term note for $11,000. So we're going to record the increase in the land asset and the decrease in the cash asset under the asset column, and we're going to show the increase in the note payable long-term liability on the right side of that equation. And letter E, we purchased $3,000 of equipment, paying $1,000 in cash and charging the rest on account. We're going to show the increase in the equipment account and the decrease in the cash account under the asset side of the equation. And then under the liability side, we're going to show the increase in the liability of $2,000. Okay, some more journal entries. And so when we receive $10,000 cash from owners and issue stock, hopefully now this seems very easy to you. We simply debit the cash for $10,000 because the cash increased, and we credit common stock because the stock increased, and because stock is a right side account, we increase it with credits, and because cash is a left side account, we increase it with debits. Letter B says we borrowed $7,000 cash from a bank and signed a note due later this year. Again, receiving cash means we debit cash because that's how we increase an asset, and we credit notes payable, and since it's due later this year, it's a short-term notes payable by crediting that liability account. Then we bought and received $800 of equipment on account. We're going to increase the equipment by debiting it, and we're going to increase the accounts payable by crediting it. Then we purchased land for $12,000, paying $1,000 in cash and signing a long-term note for $11,000. So we debit the land and credit the cash and credit the notes payable. And then we purchased $3,000 of equipment, paying $1,000 in cash and charging the rest on account. So we debit the equipment for the $3,000, we credit the cash for $1,000, and credit the accounts payable for the $2,000. Okay, that is the end of our discussion of Chapter 2 for today. On Tuesday, September 12th, we will meet again, and you will have an opportunity to ask any questions that you have on Chapter 2. I recommend that you try the Chapter 2 homework so that you'll know what questions you have. And if nobody has any questions, then we'll work on the worksheet for the chapter. But it's better if you have questions on the homework and bring those with you so we can make sure that we get all of that figured out. And if you have it all done by Tuesday, then that's good, because that gives you extra time to work on your Learn Smart that will be due Thursday the 14th. All right, have a great day, and I'll look forward to seeing you back on Tuesday, September 12th.